In this video, we're going to explore some data in Excel using the Data Analysis Toolpak. Before we begin, let's make sure we have the Toolpak added. Go to File, then Options, then find Add-ins in the left menu and open the tab. At the very bottom, it will say Manage. Pick Excel Add-ins from the drop-down and hit Go. Make sure Analysis Toolpak is selected. If you don't see it as an option, you might need to click Browse and look for it. Once it's selected, hit OK. You may be prompted that it's not installed. If so, click Yes to install it. Now let's take a look at our data. We have 5 years worth of data from the S&P 500 index taken from 2014 to 2019. A good practice when analyzing data within Excel is never mess with the original data. Instead, make copies of what you want to edit. So let's add a new sheet, then copy all our data and paste it there. Let's also remove the title so it doesn't get in the way. We want to look at the percent change. We also want to peek at the price data. Let's clean this up. Delete these other columns. Then, from our price data, let's make a line plot to show the overall trend for the period. Select the price and date columns. Go to Insert, Recommended Charts, and we'll grab the line chart. We can see here there is a general uptrend, which is no surprise. Index investing is often promoted as good at following the general market, and the general market tends to go up. So if you're in that camp of thinkers on indexes, then this trend should be pretty expected. Okay, let's look at some descriptive statistics. You're probably aware that there are individual Excel functions to get an average, median, single or multiple modes, min or max values, the standard deviations, and even a skew or other measurements of the distribution. Instead of using these functions, we're going to get all our descriptive stats at once using the Data Analysis tool. So head to the Data tab. Then find Data Analysis on the right, and scroll to find Descriptive Statistics. Click OK. Let's click in the range box and then select our range. Let Excel know it's a column. Check the box to let Excel know we have a label in our first row. And let's output this data into this sheet instead of creating a new tab or workbook. Click the white box, then just select a cell in a blank area of your sheet. This is where our data will appear. And finally, select Summary Statistics. Click OK. And there we have all our descriptive statistics. Let's make this a bit easier to read. Since our original data was in percentages, let's convert this into percentages as well, and remove a few decimals. Looks good. So what do we see here? The mean is slightly positive, 0.04%. That makes sense as we saw it had an uptrend. The median is 0.05%. Recall what a difference between a mean and a median means, which is there's some skewness, and the skewness measure confirms it. For skewness, a value of 0 is the absence of any skew. A negative skew means most of our values are more clustered on the positive side. And another way to see skew is with a histogram, so let's try that out. So back to our Insert tab. Let's select the columns, and any versions of Excel that are 2010 or later should have an option for a histogram. And we can see that there are a lot of positive points here, very slightly, but it's a bit heavier. Let's up the granularity. You can see more data clustered around the positive side and a bit more fatness in the tail to the negative side. Another interesting point is the kurtosis. A normally distributed kurtosis has a value of 3. Since this is over 3, with 3.78, we can see that it's more clustered towards the middle and has fatter tails, with some outliers that are very far out. As for range, from the lowest to the highest, you can see there is a 9.26% difference. The lowest value on any given day is roughly around negative 4.2%, while the maximum is about 5%. On a larger time frame, our range would not be quite like this. In fact, if you're aware of the S&P 500's broader history, this is a good example of how, when you're looking within a subsample and making investment decisions, it can be very deadly when you don't model for black swan events, that is, huge outliers. So if you make an investment thesis around the idea that on any given day, the market can only go down negative 4.2%, then it happens to go much over that, that could be detrimental. That's just something to keep in mind when using past data to make decisions. It's why there's always the disclaimer that past results are not indicative of future performance. What else might we explore with this data? You may have also heard the saying, you should always buy the dip. The general uptrend supports that argument, but we can pull up a different visual to examine that idea a bit deeper. Let's add a stacked area chart. And let's line that up with our line chart. And what do we mean by buy the dip? How big is a dip? Well, let's set an arbitrary rule that any day when the market dropped by 2.5%, you would have bought it. Let's draw that out on the screen. So we'd buy at the red lines, say here in September, and again in July, and you would have done quite well in even a fairly short term. You'd buy again here in Feb 2018, and it's not just when you buy, but how long you hold that matters. You'd probably have been pretty sweaty for a bit at some of these dips, but you still would have done well if you're holding it for several weeks. So we discussed how visualizations can help us with analysis and reasoning. We're better analyzing a trading principle like buy the dip with just some side-by-side visualizations. That's enough of a demonstration of these Excel tools for this chapter. In Chapter 4, as we get into hypothesis testing and inferential statistics, we'll jump back into Excel's data analysis tool to run some t-tests together with new datasets.